My name is Jim and I was retired. In my 3-bucket system, bucket 1 includes the cash and equivalents that I need for the next 3 years of my expenses. In this video, I'm going to explore bucket 2, which are the assets that need to fund years 4 through 8, 5 years of assets, income-producing assets. In this video, we'll explore what's in bucket 2. To review, bucket 1 includes the assets that I need for the next 3 years of expenses. And bucket 2 includes assets that are equivalent to 5 years worth of assets for years 4 through 8. And in bucket 3 are long-term assets for long-term purposes. I may take income from them, but I should not need to sell anything in a down market for at least 8 years. Now, in prior videos, I explored the managing my asset allocation across all of my buckets. Be sure to pay attention to that video, plus the one where I translated my numbers spreadsheet into Excel to share with you on my Google Sheets. Those will give you details on how the spreadsheets actually work to take data from Quicken for Mac and put it into a spreadsheet where I can manage the asset allocations over time and tax buckets. Digging into my numbers spreadsheet for this week's video, I discovered that Numbers has an update that actually helps. It allows you to do a little organization with the Organization tab and explore categories. So it allowed me to take the assets that were in bucket 2 and divide them automatically into taxable and tax-deferred assets. And 9% of the assets in bucket 2 are in the taxable accounts, and 91% are in tax-deferred accounts. The other thing I'm showing here is the equity to bond ratio of bucket 2. And these numbers I actually have from the 3-bucket tab on this spreadsheet. So bucket 2 has 16% equity and 84% bonds. That 16% equity is largely in one holding of a Wellesley Income Fund that includes both equity and bonds. So 5 years ago, I would have had parts of my CD ladder in bucket 2, but that's wound down and the remaining CDs are in bucket 1 and they'll mature this year and next. So there are no CDs in bucket 2. So let's look at what assets I have put there. So here's a full breakdown of what's in bucket 2. They include 2 I-bonds that we just purchased in December, a TIPS fund that's in my taxable account, a TIPS fund that's in my 401k, a general bond fund in my wife's IRA, Wellesley Income that's in my IRA, and finally another TIPS fund in my IRA. I'm actually using the same Schwab TIPS fund in both my taxable and my tax-deferred for now, just to keep things simple. It's SWRSX. Now, a few things about the Wellesley Income Fund. It is a 39% equity, 61% bond fund, and I've had this one and its sister fund, the Wellington Fund, which is in bucket 3, for almost 20 years. But this expense ratio is 0.22%, and that's about 5 times more than I'd like it to be. So I may be replacing this soon. I've had Wellesley and its sister fund, Wellington, for, I would say, close to 20 years. And they were in an IRA, which then was in Vanguard and has been rolled over into my Schwab. And if I had left it at Vanguard, I might be able to get lower priced Admiral funds for my Wellesley income. But I'm in a regular investor class, and so I'm paying an expense ratio of 0.22. It's one of my higher expense ratios. And as you know, I've been gravitating towards low-cost index funds. Wellington, which is in bucket 3, and I'll explain about that next week. Wellington is in its Admiral class, but because it's a Vanguard Admiral class, Schwab won't let me add to it. I can hold it and sell it, but not add to it. I think I have a few choices here. I can either move the Vanguard funds back to Vanguard, or I can decide to bite the bullet now and gravitate out of these actively managed funds and into my own basket of ETFs to duplicate them. To find these alternatives, I'm going to use Portfolio Visualizer, and I'll put a link to the website below. And it's a great way to do some back testing and some portfolio optimization. You can subscribe to this for $19 a month or $39 a month if you're a professional. I'm not. But I'm going to be using the free portion of this, which requires you to put in the numbers for your portfolio every time you use the tool. You can't save portfolios with the free login. First thing I'm going to do is back test a portfolio, and I'm going to back test the bucket 2 portfolio to see what kind of ingredients I need to replicate with some alternatives. So I'm going to use it month to month. I'm going to say that I am going to rebalance quarterly, and I'm going to enter the 4 main ticker symbols for this bucket. Now my I-bonds and my TIPS fund and my 401k don't actually have a ticker symbol. So I'm going to use a proxy, and again I'm going to use the ETF for the same as the SWRSX. I'm just going to put it in S, and that is the Schwab US TIPS ETF. And I'm going to use this as a proxy for those I-bonds and the TIPS fund. Now, if you know what I know about I-bonds, and please see the link above, they are a little different than TIPS funds, and they have certain advantages. But I'm going to use this as a proxy. Put the numbers in, make sure it adds up to 100%, and analyze the portfolio. And it shows you the portfolio over here. Initial balance, what it would grow to over the hypothetical period of time. Its CAGR of about 4.62% and a standard deviation of about 4%. And again, in bucket 2, you're not supposed to go for yield, you're supposed to go for stability. So the key numbers here to keep in mind are this CAGR and the standard deviation of 4%. Because the next thing we're going to do is explore some alternatives, and I'm going to use 2 ETFs that might be possible replacements for the Vanguard Wellesley income. And I'll put a couple links to some Boglehead chat forum conversations about alternatives to Wellesley income as well as alternatives to Wellington. These Boglehead folks know how to replicate the performances of these funds. So in my first portfolio, I'm going to have 100% of that. And in my second one, I'm going to replicate it 39-61. So in the same proportion of equity to bonds as Wellesley income, I'm going to put these 2 ETFs. And then I'm going to analyze the portfolios. So comparing those 2 portfolio options, you can look at the CAGRs. The second portfolio has a slightly higher CAGR, very close in standard deviation, and in the last few years, it actually seems to have outperformed Wellesley income. all good ingredients for a replacement. The other thing you'll want to look at is exposures. Under exposures, you see expense ratio 0.22 for the Wellesley income, and then go down here to the same number for the second portfolio, and it's 0.5%. Of all the numbers on Portfolio Visualizer, this is the one that I can control. I get to decide how much expense I want to spend for the next year after year after year in the investment. So that's a key ingredient on my decision to change. So the other thing I'm going to show you is the portfolio optimization. And again, I'm going to show you the optimization of all of bucket 2. So again, I'm going to do month to month. Now here, I'm going to go for a maximized return subject to that 4% annual volatility. So I'm entering the 4% that's in my wife's IRA, and then I'm going to say that we're going ahead with getting rid of Wellesley income and replacing it with the BIV and VIG ETFs. And then the balance, I'm just going to lump into one TIPS ETF, shown here, the SCHP. And now let's go to optimize. And it shows you your starting allocation and the one that it chooses to optimize for the highest return with the same level of risk. And it shows the standard deviation is 4.13%. It's a little above the 4%, but close enough. Expected return is also about the same as where it had been before. It's not much better. So there's a modest increase with the preferred ratios. Over time, this 10,000 would grow to 16,700 in the preferred maximum return at 4% volatility, and the provided portfolio where we started would have yielded about $500, $600 less. Again, this isn't a lot of money. The ingredient that I think helps the most is the expense ratio. So my 401k doesn't offer either BIV or the VIG alternative, but I do have choices. So I'll have to do a little bit more modeling to replace the TIPS fund in my 401k with what alternatives are in their offering, a split between equity and bond that comes up to a similar risk return ratio. So I'll conclude with my standard word of caution. I am not a professional. I have no initials after my name. So please take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. And be sure to like and subscribe to this channel. The more subscriptions, the more likes that the videos get, the higher it will be in the search results. Thanks. See you next week for Bucket 3.